Welcome to the Potting Shed. This is Marianne Montaigne, president of Mosaic Consulting, and welcome to Thriving with Your Money Tree. We have a return guest today. I'm so thrilled to have him back. This is the foremost gold expert in the world, and his name is George Milling-Stanley. If you've watched the previous podcast, you'll know exactly who he is. But for those who haven't, he is the former director of the World Gold Council in London, and for the past nearly 10 years now, he has been a vice president and chief gold strategist, State Street Global Advisors. So welcome back to the Potting Shed, George.
Thank you for inviting me, Marianne. I must have done something right last time, so I'm really looking forward to our conversation this time.
Well, the last time George gave us a great primer on how and when to invest in gold and how much, all key important vehicles to a total investment strategy for an individual investor or an institutional investor. And today, we are going to revisit the price of gold, where it's been going, the most recent trends, and go into those events that affect the price of gold, how they've been affecting us in recent months. And we're going to ask George to give his longer-term outlook for gold and maybe a shorter-term outlook as well. But I think key to all of this is why. So let's just start with the performance of gold since our last meeting. Well, actually, it was a few days later, gold hit a high in early May. And from that time, gold is down about 9.59%. Now, it's still in the top tier of investment returns for various asset classes on a year-to-date basis. GLD, the ETF that I recommend for gold investors, is up 2.9%. year to date. So I'm going to turn it over to George to give us an explanation of what's been going on.
Okay, look, I think a lot of people came into 2023 with exaggerated expectations. Think about it, the things we discussed last time, lending a little longer term perspective to this. In 2019, the gold price was up 18%. That's way ahead of the long-term average price appreciation, which in the 50 years I've been looking at gold since 1971 has been around 7.75% a year. So an 18% return in 2019, we were way out in front of our skis. Similarly, in 2020, gold was up 25%. So again, huge returns in both those years, way, way above the long-term average. So it shouldn't really have come as a surprise to anybody that in 2021, gold was down 4.5%, and that in 2022, gold basically went nowhere. It ended the year at almost exactly the same level as it had opened the year. And again, not doing anything very much in 2023. I think that's, that's only to be expected after a couple of years of a really, really stellar performance. But looking back to that performance in 2022, by going nowhere, gold actually outperformed practically everything else that's in the market. Think about what happened in 2022. It's easy to forget. The S&P 500 was down 16%. Global equities were down 18%. The US bond market was down 13%. Global bonds down 11%. And the crypto universe, well, in a couple of weeks during the early part of 2022, the total market capitalization of all of the crypto products that were out there at the time lost 66% of its value, fell from $3 trillion to $1 trillion. So gold in relative terms did very, very well by not going anywhere in 2022. And similarly, as you've said, it's still looking pretty good in 2023, even though in its own terms, the performance has not been stellar. But relative to everything else, gold's holding up pretty well. I think the major reason that gold has not done better in 2023 is really the fact that, think about it, jewelry demand is typically about a half of total consumption in an average year, and jewelry demand took a terrible hit during COVID. The lockdowns in many, many cities. Most of the rest of the world took lockdowns much more seriously than we did in this country, Marianne. Remember that, right? There were literally people who were locked in their homes in cities like Shanghai and Mumbai in India. So the lockdowns meant that jewelry demand fell dramatically. We were hoping for, didn't see much prospect of a rebound in 2021 with COVID still raging around the world. 2022 looked like it might be a little better. But the problem there is that the Chinese government stuck to its zero COVID policy long after everyone else in the world had abandoned that, long after New Zealand or Australia, for example, had abandoned that policy. China stuck to that until December of last year. It's only really just in 2023 that China's allowed its economy to reopen. Now, that hasn't led immediately to a big burst in economic activity, although Chinese GDP is expected to grow about 5.5% in 2023. Now, that's disappointing for the Chinese, but think about it. This country would give its eye teeth to grow 5.5% in 2023. You need to look at all this in relative terms, right? But anyway, we haven't yet seen the big rebound in gold jewelry demand that we will see, I believe, once the Chinese economy really gets motoring. Now, they've run into a number of problems in the real estate sector. This all sounds vaguely familiar of the United States in 2007 and 2008 to me, although there's a lot more corporate involvement than there was as opposed to individual involvement in our case in 2007 and 8. But they've run into some problems on real estate, and that has tailed over into the financial sector, and that I think has tended to slow any major rebound in economic activity. So we're not going to see that rebound in gold jewelry until the Chinese economy starts to grow at better than 6%, and I'd like to see it up to the sort of 7 or even 8% that we've seen in recent years pre-COVID. That I think would be very, very helpful for the gold jewelry business. Another thing, of course, is that during the Northern Hemisphere summer, the jewelry business in India goes very quiet. They're having the monsoon rains at that point, and of course, across a lot of the other emerging markets as well. So they don't have the time and energy to go looking for gold jewelry. They're too busy protecting their crops and trying to guarantee their harvests by making maximum use of the relatively rare rainfall that they actually get during the monsoon season. It's rare during the rest of the year. So they need to try to preserve that.
Could I interject in there? Because from what I've learned about the monsoon season in that region is that you want a lot of rain so that you can have prosperous crops, and it can rain in different areas, different amounts. So you need a very large amount of rain in the key crop producing parts of India, not necessarily all. And then you don't want too much monsoon, because if you have too much, then it washes things out, crops are ruined, they can't grow important things like onions, and then the prosperity of the country declines from too much rain.
Yep. I think it's like just about every other aspect of human life, Marianne. All we want from the monsoon rains is exactly the right amount. We don't want too little, we don't want drought, and we don't want too much because we don't want floods. I've not heard many reports of flooding in India, although I have heard reports of flooding in Bangladesh, which, being on the Ganges Delta, is much more prone to flooding than the rest of India is. But you're absolutely right. All we want is exactly the right amount of rain. Now, my understanding is, and it's still not clear, final reports not yet in, but my understanding is that for most of the important crop growing areas in India, the monsoon rains have been pretty close to that ideal of just the right amount. And I think what that means is that once we get through the festival season, which starts later this month, later in October, once we get through the festival season and India begins to go into its marriage season, which is a huge, long, prolonged period of gold gift giving going on, that basically runs from late October right the way through until May or June, depending on whereabouts in India you are, because the monsoon rains run in a swath from the southwest corner up through the northeast corner of the country. So we're about to run into what is typically for India, which is vying with China for the biggest consumer of gold jewelry in the world. We're running into what is typically the strongest season for gold jewelry buying. That may well be an impetus for the price during what's left of this year, 2023. And that is why I'm optimistic that we're not going to see prices down at around the $1,800 level where we are now. I think we're going to get back into the trading range that that my team at State Street predicted, that gold would trade for most of 2023 between $1,900 and $2,100 an ounce. And we've been solidly in that range most of the year. We've dipped a little bit lower in the last couple of weeks, but I'm optimistic that that the onset of the festival season is going to help contribute to higher prices before the year's out.
Okay, just want to segue into China by saying that stronger US dollar makes gold more expensive for buyers outside the US. So India's jewelry business is very important to the price of gold, and also in China. And in China, the Chinese buyers usually pay between a 5 and 15% premium to the troy ounce per versus US buyers. And that's regardless of currency. But this year they've had to pay 121% premium. What was that about?
Well, you know, I'm a great believer that the dead hand of government can really mess with markets, and I'm afraid that is very much the case as far as the gold market is concerned. The high premiums in in China are purely and simply a consequence of government interference. They limited gold imports at one point. I think that the Chinese government has also been working very hard to buy as much gold as it can from local production, because it is one of the biggest producers in the world, buying gold from local production to put into the official reserves of the People's Bank of China. So the supply side has been squeezed from 2 points. One, from the government taking as more than usual from what's available locally, and two, from the government more concerned about the impact on the currency markets. They didn't like to see their currency as weak as it was against the dollar. So they have, at one point, they moved to restrict imports. I think that's why we've had these big premiums. You've seen exactly the same kind of thing happen in India in recent years, although Mr. Modi's government, I don't think, has interfered with the gold market operation as much in 2023 as it did in the previous couple of years. But you saw the governments imposing unusual tariffs and taxes and commissions and fees of one kind or another, just to try to gain some income and also to protect their own local currencies against weakness against the dollar. And I think that's really been the major problem there. The other thing is, when you talk about the strength of the dollar, that means essentially, because it's a zero-sum game, the weakness in the other currencies. And what that means is, there are investors in this country who are disappointed that gold hasn't done better this year in terms of the US dollar. But if you look at gold in other currencies, it is at or close to all-time record highs. And that, I think, is another thing that has tended to slow the rebound in gold jewelry demand, especially in the emerging markets where those currencies have probably been weakest, Marianne.
Okay. Another country that stood out this last few months is Turkey. And their share of sales of bars and coins skyrocketed. It used to be like 4% of annual average sale in the global market, and it skyrocketed to a 17% share in the second quarter of this year. I bring up Turkey because it's not small. It's the 5th largest market for gold, although it's the 11th largest market by total economy. So sales went up 5-fold in the second quarter, when the inflation rate was 185%. We think our 3 to 4% is too high. They had inflation of 185% last October. So, the currency had to drop like a rock, and gold jewelry demand skyrocketed to 25% in the first half of this year. That's a lot of statistics, but I'm pointing to a large country with very high gold demand during a period of super high inflation and the currency dropping. And I guess the government decided we're going to cut off imports of gold. So can you talk us through that?
Okay, there are some similarities with China and with the example of India that I talked about. Some, some restrictions on imports in order to try to protect the Turkish lira and its value against the dollar. So that's been one thing, government interference yet again. But more important, I think Turkey over the last couple of years has been a classic example of where a country has, I don't know how you define hyperinflation, Marianne, but to me, close to 200% sounds like hyperinflation, quite frankly. So what you have is a country with hyperinflation, which means that the currency is depreciating very, very rapidly. These people are not buying gold in the hopes of making a profit. These people are buying gold in the hopes of maintaining the value of some of their assets, whether it's an investment portfolio or whatever it might be called. And in this country, we tend to make a very sharp distinction between buying gold for jewelry, for adornment purposes, and buying gold bars and coins or ETFs for investment purposes. It's not really the same in most of the emerging markets. Basically, they want to buy gold. They believe that gold tends to maintain its value, whether it's in a bar or a coin or an ETF, or whether it's in the form of jewelry. The other thing to say is the gold jewelry that is made in Turkey and is consumed in the local market is mostly 22 or 23 carat, much higher, much richer than you'll find in the United States, for example, much closer to what you'd find in India or the 24 carat that you find in China and throughout Chinese communities in the rest of the world. So it is very high carat and sold typically on a very, very low markup. You talked about a 5% to 15% premium in China. In Turkey, the premium over gold jewelry was typically around about 5%. I bought a good deal of gold jewelry in Turkey because I like the workmanship. I like the richness of the high carat. And I like what I think is a really, really good value proposition too. But that's exactly what Turkish people are doing. They're buying investment products where they can get them, and where they can't, then they're buying gold jewelry. And I think they're smart to do so because their currency is in dire trouble. And I don't think the government really knows how to deal with inflation at above 180%, as you pointed out. I'm still wondering whether our country has actually mastered inflation properly, because if you look at, headline inflation on the consumer price index has come down from 9.2% to 3.2%. So a number of people have said, great, we've tamed the wild beast of inflation. But what the Fed looks at is personal consumption expenditure, that index, and they look at the core, stripping out the seasonally volatile food and energy. That has come down from 5.4% in February last year to 3.9% this year. So it's still twice as high as the target rate that Jerome Powell at the Fed has maintained and has called for. And he's on record, I think, as saying that taking the first 1% out of an inflation rate is the easy part. It's taking the last 1 or 2% out that gets really, really difficult. I think that's why Jerome Powell is talking. He didn't mention the recession word. The Fed has talked about recession and looked it fairly squarely in the face for much of this year. But in the last meeting, I didn't hear the R word come up at all. But what did they use? They used this strange phrase, an extended period of below trend growth. Know what that sounds like to me, Marianne? That sounds like a recession.
So again, people are using gold around the world to maintain their purchasing power in a period of higher inflation. And we have not come to the 2% Federal Reserve goal as yet. We're still a long way. Maybe you could talk in football terms about being, within 10 yards of the goalpost. Those can be the toughest, the roughest, the more black eyes in that last 10 yards of trying to get to that goalpost of 2% inflation.
Being born and raised in England, I'm not that good with football metaphors when we're talking about American football. But what I will say is that this is a very tricky thing for Jerome Powell to do. We still don't understand the leads and lags that quite clearly exist between Fed activity and raising the federal funds rate, the rate that banks can borrow from each other, and the impact on the economy. What we've seen so far is not an awful lot of impact on the underlying economy, which seems to be pretty strong. We certainly haven't seen much of an impact on the stock market, which again seems to be pretty strong this year, after going down a good deal last year. So, I think Powell, this is why Powell has done these two hawkish pauses, okay? He paused in June, didn't raise rates, but made it very clear he was going to raise rates next time around. He paused in September, didn't raise rates in September. But again, it is very clear that in either the November or the December meeting, the next two meetings we have this year, that he's going to raise rates at least one more time this year and possibly more. And I think if I can try to read the subtext of what came out of the meeting a couple of weeks ago, I think he's kept the door open to possibly even increasing rates into 2024. Think about it. At the beginning of this year, there were three questions about what the Fed was going to do. Would it persist in raising rates? Would it pause? And if so, when? And would it pivot and start to cut rates? Well, they're still in persisting in raising rates mode. No question about that. We have had two pauses, but they were hawkish pauses, so I don't think they really count. He certainly hasn't stopped raising rates. I think he's waiting to see. He likes the idea of having a couple of months of more data under his belt before he decides to make a decision for the November meeting and possibly even for the December meeting. But I think he feels that it is very important to get the core rate down to that 2% level, and he is a long, long way from doing that at this point. There's a lot more work to be done. He said this himself. He said that we don't understand these leads and lags, so it's very, very difficult to assess what is the impact of the increase in interest rates from 0 to 5.25%. How much of what has happened in the markets is because of that, and how much of it is because of exogenous variables, like, for example, the easing of some of the supply constraints that pushed inflation up in the early months of COVID. I think there's no question that some of those have eased, but we still have some constraints on supplies of food and energy in particular because of the continued conflict in Ukraine. So all of those things, I think, are weighing very, very heavily on Mr. Powell's decision-making.
Yep.
I'm glad I'm not the chair of the Fed. Let me put it that way. I'm sure it's a wonderful job to have. I just wouldn't want to have it right now.
Well, when you also look at the dot plots that the Federal Reserve released, I think people were disappointed, and that's been pushing rates higher and stock prices lower since their decision was announced. There were a lot of people who believed that we were going to get 2 percentage points cut from the Fed next year. And their best guess, which is what the dot plot is, it is not a plan, it is the best guess. People don't always understand that. But their best guess was that rates would only be cut by 0.5% over the course of the year. So I think that makes a stronger case for gold right there, that we're going to have higher interest rates and for longer.
No question. I think that meeting 2 weeks ago brought a significant re-rating in people's expectations. Powell was rather kind to forecasters. He said, I think the quote was, he's conflating two quotes here, but he said, they're a humble lot with much to be humble about, which I think is rather a nice way to put it, because they don't know what's going to happen, so therefore they have no choice but to have humility. But what that did, I think, there were a lot of people who'd been expecting a pause in the third quarter of this year. Well, we didn't get a real pause in the third quarter of this year. And Powell, I think, has made it clear we're not going to get one in 2023 at all. Whether we get one in 2024 is going to depend on the data, on the employment data, and on the economic activity data. And I think, given that there's often a disconnect between the two, I think he's also looking at what's going on in the stock market. The stock market doesn't necessarily reflect any signs of health in the underlying economy, for example. So I think he's biding his time, which is a smart thing for him to do. But the notion of when we might pivot, At the beginning of this year, people thought the pivot to cutting rates would come in the fourth quarter of this year.
Right.
He's made it very clear that's not happening.
Right.
In fact, if I read him correctly, I think he said he didn't really see much opportunity for a rate cut in 2024. So he's pushed the pivot out for another 15 months, which I think is something that the markets are going to have to come to terms with. And they're going to have to figure out how to adjust to that re-rating of expectations, if I can call it that, Miriam.
Okay. Well, before we get to your long-term discussion of gold, let me throw out the fact that Costco saw an opportunity here, and they issued or sold gold bars in their stores, and they sold out very quickly. I guess it was a discount in the price. Sounds like a one-time retailer kind of bring people into the store, bring people to the website type of event. But I want to point out here, because we've been talking about bars and coins, here's my take on why you should own ETFs in place of those. And the first thing is that, as you described in your primer for us, you can own gold, which is traded every hour of the trading day, 5 days a week, at a stated commodity type price. And you can do this knowing that the stacks of gold in each ETF are audited every single day. In effect, they're audited every single day.
Yep.
And, you know, I have a personal story, and it involves this. My godparents decided to keep gold at their home, and they went to a reputable store that sells gold. And my godfather was followed home from the store. And I hear that this happens all the time. The police are not the least bit surprised. If you store gold in your home, it is not insured. If you store gold in a safe deposit bank box at the bank, it is not insured. If you tell the bank you're putting gold into, you know, their building, they'll tell you, we are not insuring this. There is no place to store gold bars and coins that is insured. If you tell others that you're going to buy gold or you own gold, you're just setting yourself up for trouble. So my godfather was followed home, and he took his coins or bars, whichever, to his basement and put them into his box in the rafters. And this is all in a very lovely neighborhood. And again, he went to a reputable dealer. But people are watching you as you go in and out. They figure you've got gold in your pocket one way or the other. You've probably got cash in your pocket one way or the other. So he proceeded to leave the basement, go outside into the backyard, and two men purporting to be utility inspectors of some kind came to the front door, and my very frail godmother answered these two guys at the door, and they kind of pushed her aside. Fortunately, did not knock her down in all her frailty. And they ransacked the house, and they went toward the basement. They knew a light went on after he got home. And so he was robbed of $35,000 in gold. And I think his ego was hurt more than his bank account was hurt. But it's just a case that is very, very common. I tell this to people all the time, and they tell me, well, I heard of something like that in my town. So, you know, and again, this is what the police will tell you also. You can be followed here and there. So don't do it.
Dreadful story, but a salutary lesson, I think, for people.
It is. Just forget the gold bars, forget the gold coins, buy the ETFs, know that they are in a safe place, in a vault, audited every single day, and you pay a very minor fee to have that position and trade it whenever you want to.
Makes a lot of sense to me. I think, as I say, I've heard horror stories like this, many of them. You know, it's a dreadful story, but I can understand it. You know, it's an easy thing to do, to lurk around outside a coin dealer's office and to follow somebody, knowing that they've either got a bunch of cash or a bunch of gold, and that they're going to put it somewhere where it's probably not very securely stored in their home.
Right.
It's not a great way to invest in this wonderful product.
Right.
As far as the Costco thing, I think that was interesting. You mentioned maybe a discount. I think there was maybe a discount over the price that they had originally planned to sell these gold bars. But my understanding was they were a significant premium over the value of the gold contained in the gold bars, which typically is in the retail market. That is actually typical. If people are buying gold coins or gold bars, they're going to pay a substantial premium up front. And what nobody tells you when you buy gold that way is that you're probably going to suffer a substantial discount on the back end when you come to sell.
Right.
If those discounts are 5%, I mean, if the premium is 5% and the discount's 5%, gold's got to go up 10% before you break even. That's a lousy bet from my point of view.
I agree. So let's turn to your outlook. Let's talk about the long-term importance of gold in your portfolio, just briefly, and then, where you see gold going over the next, say, 12 to 18 months.
I know you've heard me say this before, Marianne, but it bears repeating, so I'm going to repeat it. To me, the historic promise of gold to investors has always had a dual nature, and I like to talk about an asset that has two reasons to own it. The first part of the promise is that over time, gold can help to enhance your returns of your portfolio. It won't necessarily do it every year. It didn't do it in 2022. It didn't do it in 2021. But it did it in spades in 2019 and 2020. So over time, gold can help to enhance the returns of your portfolio. That's that long-term average price appreciation of 7.75%. We talked about it at the beginning of this. The second part of the promise is that irrespective of whether gold is going to enhance your returns, it will always help to reduce the volatility of your portfolio. Volatility equals risk. So if gold can help to enhance your risk-adjusted returns, then it deserves a place in every portfolio. That's really the bottom line as far as I'm concerned. I like something that does all of those things. Now, aside from those I think are two very, very good reasons to own gold, and very good reasons as to why, even if for some reason people would choose to reduce an allocation to gold, I always advise them never to go to zero, never to sell out all of the gold. Keep gold in the DNA of the portfolio. It's a lot easier to increase what is already an allocation rather than starting an allocation to gold. So that's what I'd say there.
Right.
The other thing gold's doing, we know that it acts as a hedge against inflation. We know that we have inflation that it's a level that the Federal Reserve still worries about. Even if most of the popular prints have decided it's not an issue anymore, the Fed is still very concerned about inflation and believes it's sticky. So gold, I think, is going to help as far as that's concerned. We know also that gold has in the past always offered some protection against potential weakness in the US stock market and against potential weakness in the US dollar. I don't know when we're going to see weakness in the US dollar. It has been, to my mind, unusually strong this year.
Yes.
I thought the dollar had peaked in October of last year. It came down significantly in November of 2022. But it has been stronger than I had expected this year. I'm not expecting that strength to go on forever. I'm looking for what the economists call a reversion to the mean. And what I mean by that is that I'm looking for other currencies around the world to rise against the dollar. And given that gold often acts as if it were a component of the currency market, I'm looking for the gold price to go up against the dollar too, along with those other currencies. Okay. Not happening today, but that's what I'm expecting over the next 6 to 18 months.
Okay.
So that's part of my outlook too. But as I say, there are those other reasons why I like to own gold. The other thing, gold doesn't really move with any significant relationship with the other components of a typically balanced portfolio. It doesn't really move in line or alternative to the equity market or to the bond market or to real estate or to, private equity or hedge funds or any other things that you might put in a properly balanced portfolio. And because of that, then I think gold is lending a measure of diversification. And, as Harry Markowitz told us in Modern Portfolio Theory back in the early 1950s, diversification is the key to decent portfolio returns over the long term. It may hurt you in the short term, but over the long term, if you have a properly balanced portfolio, it's going to pay off. And I think that gold can be part of just about anybody's properly balanced portfolio. So a whole raft of reasons, as I say, why I think gold is a good thing to have. As far as the outlook is concerned, I'm only going to go out 6 to 18 months, so until till spring of 2025. Let's be brave here. My sense is that gold is fairly quickly going to get back into the trading range that my team had predicted for 2023, between $1,900 and $2,100 an ounce.
Well, George, it seems like we've traveled all over around the world and came back to the same target price that you had back in May. So thank you once again for your time. And for those who are interested in hearing more podcasts, go to either YouTube for Thriving with Your Money Tree, all one word, followed by the number 1, or you can find me at www.thrivingwithyourmoneytree.com and get more information. Thank you for your time today.